James, you gave us some limited information last night about the exposure the bank has to Russia. Clearly, this is an evolving situation. How great a handle do you have on the bank's exposure in terms of a sort of primary exposure and then, I guess, more sort of complex and further down the road, second, third round effects?
So, Guy, that's exactly how we're thinking about it, first, second, third round effects. Let me start by saying we're obviously horrified by the images we see every night and the conflict in Ukraine, and we look forward to some resolution and an end of the suffering that's going on. As we manage our company, though, as you say, we've been very focused on initially the first order impacts. We think, as we disclosed last night, we've got those very well under control. Very modest exposure altogether from a credit perspective on a net basis, about 600 million. And then from a market risk perspective, we were defensively positioned and have managed, I think, quite well through these early days. As you say, the second and third order impacts of this crisis are harder to judge. Literally, as of today, we feel comfortable that we've got those second order effects contained, and we're doing work with our first line and risk organizations to understand, together with clients, what the long-term ramifications might be.
You have, just to stay within the bank for a moment, we'll talk about the clients in a couple of seconds, but you have circa 1,700 people in Russia. 1,500 of those work within an IT center, a tech center. How are you managing those people? How are you managing the connection between that IT system and your IT systems elsewhere?
Well, look, this is a situation that, while no one could predict exactly the circumstances, obviously we've been aware of this potential risk for some time. We'd taken steps over several years to manage down that risk, including terminating contracts with external providers. Now, as we're looking at the situation, we're being very proactive. As we've said externally, we've conducted some tests. This center, incidentally, is really not engaged in managing our production systems. And so we're able to operate the bank in terms of our production systems without need for the support from that tech center. And as I say, we're being very proactive about defending from potential cyber risks generally, but also with respect to our exposures there.
It's been a very busy start to the year. How has the bank performed in the last couple of months? Has it performed above or below expectations? We've seen obviously a significant repricing in terms of Fed, ECB expectations. We've now got the Ukrainian situation, the Russian situation to deal with as well. What impact is that having on the bank? What have you seen over the last couple of months?
Well, look, we're very pleased to share with our investors this afternoon sort of an indication of how we've traded and managed through the first 2 months of the year. I think the critical message is we're on track, delivering against the promises that we made 3 years ago, and we've continually updated the markets about is how we've been positioning the company to meet its financial targets for 2022. First 2 months of the year have been quite successful for us. We're at or above our plans in all of the businesses. So revenues in line with or above plans, better than prior year. And the expense trajectory that we shared with investors in January, we're on track to deliver against. As you say, the markets have been dislocated in a number of different ways. In the early part of the year, as people look towards a tightening cycle, potentially more accelerated even in Europe than we'd anticipated. And now we've gone through a period of real volatility. And it's a credit to our people that we've been able to manage through that, I think, really successfully, and importantly, support clients in this time.
Well, let's talk about the clients. How are they managing the situation in Russia? How many of the clients have already withdrawn? Those that are staying? How do you help them in this kind of environment? Obviously, we've seen significant changes to the SWIFT system. How do these clients manage even basic things like payroll? Is that still possible? How does it happen? And how, as you manage that process, do you manage risk for the business?
Well, listen, it's complex, and we've been extremely tightly coordinated and across the bank. I think, again, to the credit of our managers, of our client service people, we opened a help desk essentially day 2 of this crisis to hear inbound questions and advise clients on how they should respond. There are a number of different dimensions. One is, of course, payments, and they need to manage their payment situation, but also essentially restructuring their operations to be stable in a post-sanctions world. We are present in Moscow to support our clients. We're largely there sort of in support of multinationals. And of course, as they adjust their business models, we adjust the services that our service footprint, if you like, adjusts with them. And then finally, the market risk. We've been able to create markets to help clients, both institutional and corporate clients, manage their exposures, their risks associated with this recent crisis.
Let's talk about the announcement that you've also made today, and that is related to the next 3 years. Christian Sewing, the CEO, has been here for nearly 4 years, stabilised the bank. You're now looking for an evolution, not a revolution, in terms of what you're going to do with the bank. Just talking about the numbers, you are setting yourself interesting targets. They are targets that are going to require quite a lot of discipline in terms of what you're going to need to do to make them happen. But you basically are looking for a company that's going to go from a $25 billion company, euro company, to a 30 billion euro company. Just talk me through what is going to be necessary, what is going to change within the bank as we go through this evolution to make those numbers possible.
Sure. Well, thank you for the question. First of all, we call this strategy our global house bank strategy. And in many respects, it's the legacy of this institution. It's what we've been since 1870. We want to be the first call client or service provider for our clients. And we think we've positioned the businesses to be exactly that across all 4 of the core businesses, to support their clients with their global needs and managing risks and managing through the uncertainties of the coming decade. As you say, financially, that requires that our businesses capture the growth opportunities that lie ahead. We think those are attractive growth opportunities, creating a compound revenue growth rate of between 3.5% and 4.5% for the group over the next several years, which leads to the approximately 30 billion of revenues that you speak to, supported incidentally by the interest rate environment, which is finally a tailwind for us.
Yep.
Together with that, we need to be disciplined on costs, continue, in other words, the work that we've done over the past several years. But one thing that's different is we think there's an opportunity to reinvest in the businesses, reinvest in growth, invest in technology. And that's a feature of our strategy.
During this period, you are going to get to the point where you're covering your cost of capital, which is going to be a huge step forward. As you say, you are looking to reinvest in the business as well. I think the numbers you're looking to generate around 20 billion of capital, of which 8 is going to go back to investors in the forms of buybacks and dividends. 12 is going to remain within the business to be invested. Just talk to me about where that 12 is going to go. Where are the priorities during this period?
Sure. Well, look, it is absolutely our aspiration. We need to execute on our strategies and plans, but we're very confident about the path that you outlined, which is approximately 20 billion of organic capital generation over the next several years. The reinvestment sort of splits about 4 billion, if I'm thinking average tangible equity, about 4 billion of retention required to support our our Basel III capital requirements. So there is some amount that's just to reflect those requirements. And then about 8 billion goes into the businesses. What you'll see is that the composition, so the allocation of equity in the company remains relatively stable over the next several years, really 21, 22, and through to 25. But underneath that surface is work that needs to go on to offset the impact of Basel III in the business models that are most affected by it, so become more efficient with the resources over time, and in order to keep that capital allocation stable. And we think that's in itself is a strong signal.
You talked about the interest rate environment becoming a tailwind. The cost environment is going to become more of a headwind, it looks like, going forward. We've got sort of broadly very high inflation. We've also got a talent war that is raging within financial services at the moment. Just talk me through what your expectations are in terms of cost. Talk me through whether or not this talent war is going to lead to a permanently higher cost story when it comes to labour. Is the inflation story, in your expectations, in terms of the numbers you're plugging in here, going to be one that is going to be with us for a while as well?
Well, look, we do see inflation risk, no question, in compensation expenses and also other expense categories. We're in the, I think, in some ways, lucky situation of having clear programs underway to deliver efficiencies in the next several years that are not sort of on the whiteboard. They're in place and being acted on. First of all, about 2.7 billion of the cost base from last year of 21 it will fall away reasonably programmatically in transformation expenses. The Single Resolution Fund assessment will go away. So things that we can see and are quite are quite certain in terms of their delivery. And then the deliverables we have underway, so the projects, initiatives we have underway, we think will deliver about 2 billion euros of additional savings over this period. And it's that 2 billion euros that we reinvest in the businesses. That gives us some buffer, Guy, to deal with the inflation uncertainty that's out there and still deliver on the profile that we'd like to for 2025. The war for talent is absolutely present, and we think we're competitive in that war for talent. But it will continue, and we need to make sure that we are in the position to attract and retain, the best people to support the business plans that we're outlining.
Just give me a sense of how tough it is. I listen to Jamie Dimon, I listen to what he says about this. I will pay whatever it takes to get the best talent. How competitive is it?
Well, look, interestingly, it depends very much on location and as well as the activity that you're talking about. So, we certainly see some areas in the marketplace that are extremely competitive, but they might surprise you as to what they are. So, to give you one example, audit is an area where there's a huge demand for people, for trained staff. As many of the banks are trying to do the same things in terms of their control environments and what have you, and so there's competition for those people. We are, I think, being quite nimble in the strategies that we employ to make sure that in each activity, in each location, we have the right people on the field. I think in the areas that are high, sort of call it intellectual property and client-facing talent, like investment banking, say asset management, client service areas, we think we can be very competitive, both in terms of compensation, but also the platform that we are. As a global house bank, we have a really differentiated proposition to approach clients with, and we think our people will respond to that.
Final couple of questions. Christine Lagarde is going to be talking a little bit later on today. Do you see that there is any need within the system for extra liquidity?
Absolutely no. On liquidity, there is liquidity. Look, in any crisis, it's one of the first questions you ask, but what's visible to us is that there's been absolutely no stresses in terms of liquidity, or even things like collateral calls in commodities areas and so on. We aren't seeing at this point, certainly in our business, stresses that would cause us any concerns. I think the central banks have an interesting and difficult challenge ahead of them, which is inflation has been persistent. This crisis is likely to further that persistence, at least in energy, but also other commodity prices. And so while it's the central banks don't want to destabilize financial markets at all, they also need to look to the future and to the task they have ahead of managing this inflation wave. So I look forward to hearing what the ECB's views are this afternoon.
James, thank you very much indeed.
Thank you.